Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Asian stocks erase earlier losses in volatile trading. Japan rebounds as investors continue to adjust to signals from the central bank. Upping the odds, JP Morgan says there is an increased chance of a US recession this year. This as it estimates 3/4 of the global carry trade has now unwound. And the latest earnings from Siemens and Munich RE. We're going to speak with executives from those companies later this hour. We have the earnings crossing right now from that global conglomerate that is Siemens on the industrial front. Third quarter industrial business profit beating estimates for Siemens. We know there's a focus on the European part of the business and any softness out of China. Third quarter revenue coming a little softer than the estimates, 18.9 billion euros. But in terms of orders, that number is above the estimates in the third quarter. Orders coming in just shy of 20 billion euros. The estimates had been for 19.5 billion euros. In terms of comparable revenues, you've seen an increase of 5%. The estimates had been for 4%. So it's a beat on that level as well. In terms of net income, a solid beat coming through from Siemens in the third quarter. Net income at 2.1 billion euros. The estimates had been for just shy of 1.8 billion euros. In terms of the outlook, waiting for lines on that from this company. But again, the top line, when it comes through in terms of the industrial business, it's a beat for Siemens in the third quarter. We also bring you earnings coming through from Allianz. This stock, by the way, up around 8% year to date. We look at the flows when it comes to PIMCO. We wait for the details on that front. For the second quarter, though, this insurance company and asset manager coming through with operating profit above estimates. It's a beat coming through in the second quarter for Allianz with operating profit of 3.93 billion euros. The estimates had been for 3.66 billion euros. Still seeing full year operating profit at between 13.8 billion to 15.8 billion euros at the top end of that range. So maintaining its full year operating profit coming through from Allianz in terms of the outlook. And it's a beat in the second quarter on operating profits. Revenues of 42.6 billion euros in the quarter. Let's check in on the markets more broadly then. Investors, of course, will be weighing up the latest earnings coming through again today in Europe. Some of the earnings stories as well of yesterday stateside. Currently, futures pointing lower, though, in Europe by a full 1 percentage point. There is a lack of certainty, it seems, in these markets. And again, caution coming through on the Asian trade, given what we've been seeing from some of the details crossing on the BOJ and expectations about where rates go from here. US, the session there turned weaker and ended lower by around 1% for the S&P E-minis. Nasdaq 100 also ended lower. Nvidia dropping a little over 1%. So European futures pointing to losses of 1%. FTSE 100 futures here in the UK looking at losses of 45 points. S&P E-mini stateside currently flat. Again, that lack of direction. We have the inflation story, of course, in terms of CPI next week out of the US, but jobless claims today will be scrutinised. Nasdaq futures point to very modest gains of 0.3%. Let's flip the board and look cross asset. We had a weak sale in terms of 10-year treasuries. That was assessment of most out there, at least, and you saw yields moving slightly higher on the back of that. 391 right now, yields down 3 basis points on the benchmark 10-year. You have a 30-year auction later today stateside, so keep an eye on that one. The Japanese currency, the Japanese yen, currently up 0.3% at 146. Brent, $78 a barrel, gaining 0.1%. And Bitcoin getting some relief after a judge ruled around a case focused on Ripple Labs with a payment far less than some had expected, giving the crypto space a bit of a boy. 56,886 on crypto. Let's cross over to Asia right now. Avril Hong standing by in Singapore. Avril, what are you looking at?
Tom, it is another day of Japanese narrative playing out in equities and the wider region. We're seeing today for a second session, the Nikkei, the topic, started the day on the back foot, pulled into the green midway, and then now look at where it is again. It's a lot of volatility, a lot for investors to digest. Part of this is the confusing messaging we're getting from the Bank of Japan, but also consider the negative handover that we got from Wall Street, concerns about possible retaliation by Iran, and of course that weak U.S. Treasury auction. In terms of Japan, we got a 30-year auction today. It saw pretty decent demand, and this is after yields have been picking up after that global rally at the start of the week. Now let's flip the board. You see there the rest of the region looking pretty mixed. I want to highlight what we're seeing in the Japanese yen, because today there were some expectations that the summary of opinions from the BOJ's July meeting would perhaps reinforce the hawkish messaging from Ueda last week. Indeed, we got one BOJ member saying that they see the neutral rate at 1%. This is far off the 0.25% where we are right now. So leaning a bit hawkish, but after what we got from Uchida yesterday, there doesn't seem to be a coherent message coming out from the central bank, and this is a very reactive market we're seeing. The yen is climbing a fair bit, but still far off the 141 level, so relative weakness in the Japanese currency. In terms of the Chinese yuan, what we are watching is how today the PBOC set the fix above the 714 level. This is the weakest level that we've seen since November last year. So the signaling is that maybe they don't want too strong a Chinese currency with the economy in this state. Flip the board again. Just want to show you this chart, which will illustrate the volatility we're seeing in the Nikkei as well as the yen. Highest level since 2008 on the Nikkei vols, and for the 1 month implied volatility on dollar yen, highest since 2020. Tom.
OK, the volatility remains across Japanese equities. Avril Hong with the check in the Asian markets out of Singapore. Thank you very much indeed. Now, US Treasuries have been sliding as the turmoil that gripped global markets earlier this week subsides. Yesterday, investors shunned a sale of 10-year notes offered at lower yields. Let's bring in Mark Cranfield at this point, our strategist from the MLive team. You're actually seeing yields a little lower so far in the session across the Treasury curve, but we did see that move higher in yields yesterday. This was described by many that we quoted at BN who looked at this auction or participated as weak in terms of the sale of these 10-year Treasuries in the US, Mark. Does that suggest that the bond rally, at least towards the back end of the curve, is done?
Yeah, quite possibly. This week we've actually seen a low print of 3.66 on the 10-year Treasury yield. And unless investors really believe that a hard landing is coming for the United States and coming fairly quickly, it'd be pretty hard to go below that level, especially when the Federal Reserve is trying to push back a bit. They don't want people pricing in 50 basis points for September until they're absolutely sure that they need to do that. And of course, they would prefer just to move by 25 basis points if they can. There's a lot of data to come out even before that meeting. So you would expect them to try to be a little bit cautious. But certainly the Treasury market has got way ahead of itself. Trying to sell 10-year bonds more than 150 basis points below the federal funds rate is a bit of a stretch, unless recession is just around the corner. And that, although some people are raising their expectations, there aren't many people who have a base case that recession is coming within the next 3 to 4 months. So it's only a possibility. It's not something a lot of people want to invest a lot of money in at this moment. So with all that considered, to try and keep 10-year yields below 4% is not going to be easy, and we may well have seen the lows for quite a while.
OK, 391 right now on the US 10-year. And you talk about the data, Mark. So we have the jobless claims out later today for the week. And then, of course, we have CPI inflation data out of the US next week. How sensitive is this Treasury market now to those data points?
Well, they are the two key ones. So jobs and inflation, they're much more in play than they've ever been before, particularly since Jerome Powell cited some weakness in the jobs market himself. So every piece of data which tells us more about what's going on in the jobs market will be scrutinised very closely. We're expecting about 240,000 on the claims today, not much different from last week. But if we get a bigger number, certainly room for plenty of volatility. The market is probably much more sensitive to anything that enhances the idea that the American economy is slowing down quicker than the Federal Reserve expected. Anything which suggests that we're going to go beyond a soft landing, that's where traders are particularly keen to see information about that. So yes, they'll be watching this very closely, but in many ways the CPI report is even more important, because that's the one where the Fed has been looking at those numbers gradually coming down. They'll want to see another soft number next week. There's still one more even before they meet in September. But all of this is coming together in a picture. The Federal Reserve would like to see it all staying on a gentle path, but as we've seen with recent events, they don't always get what they want. and there's certainly room for volatility today and again next week.
OK, brace potentially for additional volatility. MLive strategist Mark Cranfield with a preview, of course, of the data and what it could mean, of course, for these markets. Well, jobless claims later today, and then, of course, inflation out of the US next week. Mark, from our MLive team, thank you. Here's what else to be thinking about today, then. 1:30 p.m, yes, it is the US jobless claims, so watch that, given, as Mark was saying, the sensitivity now to these markets around any softening in the labour market and what it means for repricing around Fed expectations, with markets still putting in pricing around a 50 basis point cut in September, with a full 1 percentage point of cuts coming through expected by these markets by the end of the year. 6 p.m. UK time, it is that 30-year bond auction. Pay attention to that, given the lacklustre demand that we saw for US Treasuries 10-year and that auction yesterday, the weak auction, and the ripple effects across the markets on the back of that. So that 10-year auction, really important for these markets later today out of the US. And then on the earnings front, Paramount earnings coming through. We've had some earnings, of course, from some of its competitors, including the likes of Disney. Bit of a mixed picture when it comes to Disney earnings. So you'll see what the read across is for Paramount later today. You can get around, of course, of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB Go on the terminal. A couple of stories in focus today in terms of Daybreak. JP Morgan raising its US recession risk to 35%. That's by the end of this year. 3/4 of the carry trade now unwound. That is also a call from JP Morgan. And the BOJ, in terms of the details coming through after that most recent hike, did not see July hike as policy tightening in terms of what we got from some of the members. And again, that was before the rout in these markets, and the view from one member that maybe 1% is the neutral rate for the BOJ. Coming up, European gas futures jump on reports that Ukraine has seized a gas transit point just inside Russia. We're going to look at how prepared the region is for potential supply shocks. That's next. Plus, we're going to be speaking exclusively with the CFO of Munich RE, Christoph Jurecka, about their latest earnings report and how the reinsurer is adjusting to cyber challenges and the climate crisis. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Thursday. Now, European gas prices have surged to the highest level this year following a report that Ukrainian troops seized a key gas transit point near the border in Russia. Russia's state-controlled Gazprom PJSC declined to comment, as did Ukraine's Defence Ministry and General Staff of the Armed Forces. Let's get more details then and bring in Bloomberg's Dan Murtaugh, who has always got a finger on the pulse, of course, of the energy space for us. Dan, what do we know at this point?
Well, it's still mostly rumors, but the Ukrainians invaded across the border in Russia and apparently have gotten a hold of a pipeline from a transport station in Sudzha. Now, that's the last station before Gazprom's main pipeline enters Ukraine. Russia has basically stopped all pipeline gas flows into Europe save for this one pipeline. So if anything happens to these flows, that would be the last link of Russian gas entering over the land borders into Europe. It's a small amount, though. It's about 3 to 5% of Europe's total gas supply. It mostly serves Austria and Slovenia. So there's not a huge risk of any kind of widespread shortages. And for right now, the gas flows seem to remain normal. Ukraine said that basically if it wanted to stop the flows, it could have done so without taking over this pipeline substation. And so they're planning on keeping it running. We have not heard anything from Gazprom on whether they want to keep the station running to keep making money, or if they're going to try to turn off the spigot. And so that's why you're seeing a little bit of extra risk on with futures prices jumping up about 3.5–4% to the highest level of this year.
Dan, what is your understanding right now of the sensitivity then of European gas markets to this kind of risk, and where inventories stand as we get to this mid-year point here in Europe?
Yeah, so right now Europe's actually pretty well supplied. Its inventories are up in the mid to high 80% range, about 10 percentage points higher than they normally are this time of year. The big problem is that it's been really hot, both in Europe and also in Asia, which has been driving a lot of gas demand across the world. You have places like Taiwan and India, which have set records or multi-year highs in LNG imports. And so Europe's actually seen a decrease in LNG imports in recent months as more of the product has been shipped over to Asia. That means that if this pipeline has an outage and Europe needs to fill up its supply, it's going to have to outbid these Asian buyers for it. And so that's going to obviously add to costs, and that's why you're seeing traders try to get out ahead of that just in case.
And Dan, you talk about Asia. You're sitting there in Beijing, of course, the Chinese capital. What is your sense of the demand picture out of China? All these concerns, of course, about the relative softness of the Chinese economy right now, the inability of officials and policymakers there to turn things around. When it comes to that energy consumption need of that major energy importer, what is our understanding of where that picture is at?
Yeah, it's a really complicated picture right now, Tom. We're seeing a sort of different pressure points across different commodities here. But on the energy side, fuel like oil and gas has been a little bit softer. Power demand is going really strong this year because it's been hot. There's been air conditioning needs. You're seeing new data centers. You're seeing a lot of like EVs hitting the road. And so power consumption is running really, really strong. But gas outside of the power sector has been relatively weak because there's been less industrial demand as the property market crisis continues to unfold. And we're starting to see oil demand decline a little bit and imports drop, partly because EVs are starting to crowd out gasoline cars on parts of the country and reduce gasoline demand, and partly because diesel is being hurt by the lack of industrial activity and the lack of construction.
Dan Martel, thank you very much indeed, joining us out of Beijing on this story around Ukraine pipeline risks and the Asia component to that energy story as well. Dan, thank you very much indeed. Coming up, exclusive insights on the Adani Group's infrastructure ambitions as we ask one of its next generation of leaders about the impact of the Hindenburg short seller allegations.
I think it was definitely, personally speaking, a very stressful and tough time. Emotions were high.
Welcome back to Bloomberg Daybreak Europe. More now in our exclusive series on the next generation of leaders being groomed to run India's $213 billion Adani Group. Jeet Adani is the youngest son of the conglomerate's founder, Gautam Adani, and heads their airports and defence businesses. The 26-year-old was a relative newcomer when short seller Hindenburg's allegations of fraud rocked the group last year. We asked him how that period impacted him and his family.
Jeet Adani is the youngest son of Indian billionaire Gautam Adani. As part of the tycoon's succession plan, the 26-year-old engineer is overseeing the running of 7 airports across the country, including the one in India's financial capital, Mumbai. The Adani Group is also building a brand new airport for the city at a cost of $2 billion. Along with airports, Jeet is responsible for the defense business, while also looking after the group's digital initiatives. The youngest of the next generation of Adani leaders is being groomed to run big parts of an empire that's been rocked in recent years. In early 2023, just a few years after Jeet joined the family business, a report published by short seller Hindenburg Research accused the company of fraud and share price manipulation. It sparked a $150 billion meltdown in shares of group companies. The Adanis have denied the allegations, and their shares have recovered, but they're still dealing with the fallout. Bloomberg's Anto Antony spoke exclusively with Jeet Adani and asked him how the group's strategies have changed.
You had just joined the business when the Hindenburg report came out. How did it affect you personally, and what role did you play in that crisis situation?
I think it was definitely, personally speaking, a very stressful and tough time. Emotions were high. But I think the most important thing that was on my mind definitely was, what can I do to support, obviously, the family? But more than that, how do I support the larger family, which is the employees? Because the biggest risk that you run in times like these is demotivation, people sort of losing hope, and to make sure that everyone is motivated, everyone knows that what we are doing is for a greater purpose, it's for we're making real impact, and we continue day on with the work, because these things, they happen, they come, they go. But we don't want to lose motivations.
Some of the investigations or probes or allegations are still an overhang on the group. How are you assuaging the investors' concerns in these times?
So I think, and this is based on some of the interactions that I've also had with investors over the past couple of months. I think there's a clear understanding with the investors that, with the Hindenburg report, everything that was said and allegated against us was sort of just rehashing old things again. And a lot of investors really appreciated the kind of communication that we've done over the last 18 months. At the end of the day, not a single investor's query will be left unanswered. We were proactively reaching out to investors after each and every report or article or anything that was coming out. And with all the performance from the financial side also, they were very clear that, look, this is a very good asset. All of the companies, they have strong infrastructure assets, and the leadership team has given us enough confidence by communicating with us enough. I think that's kind of helped actually investors to realize that, to look beyond this and actually look at the asset, look at the leadership team, what kind of cash we're generating, and what kind of growth we're doing.
Jeet Adani there, the youngest son of Indian billionaire Gautam Adani. Now to some other stories making the news this Thursday. Disney has reported mixed third quarter results, with weakness at its theme parks offsetting its first ever profit in streaming. Disney sees pressure on park attendance lingering for the next few quarters after previously predicting a rebound in the final months of 2024.
The lower income consumers are a little bit stressed and shaving a little bit off of their time at the park. And then higher income consumers are tending to travel overseas a little bit more right now. So we really just see this as a few quarters of slight perturbation in the numbers. Frankly, I think we're going to be right back as we get into the middle of next year.
Meanwhile, Warner Brothers Discovery shares tumbled in late trading after second quarter results that missed expectations. The parent of CNN posted a charge of $9.1 billion after writing down the value of its traditional TV networks. The firm has concluded that cable channels are no longer worth what they were back in 2022 when Discovery acquired Warner Media. And Cathie Wood has scooped up shares of tech firms caught in Monday's market rout just as her flagship fund sank to a new low for the year. Wood's ARK Innovation ETF bought Amazon, chipmaker AMD and streaming device maker Roku, among others. ARK closed Wednesday at the lowest levels since November, down more than 20% this year. Coming up, anti-racism protesters turn out in their thousands to counter far-right gatherings that failed to materialise. The latest on the UK unrest next. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Asian stocks erase earlier losses in volatile trading. Japan rebounds as investors continue to adjust to signals from the central bank. Upping the odds, JP Morgan says there is an increased chance of a US recession this year. This as it estimates 3/4 of the global carry trade has now unwound. And Siemens says weak demand for factory automation is hitting returns. We're going to speak with the CEO of the German industry giant and the CFO of Munich RE shortly. Talking of earnings, Munich RE lines crossing right now. So we update you on the latest earnings lines coming through from Munich RE. In terms of the second quarter, it's a beat for this reinsurer. Second quarter net income coming in at 1.62 billion euros. The estimates had been for 1.56 billion. So the reinsurer coming through with a beat in the second quarter when it comes to net income. In terms of the outlook for the full year, Munich RE still seeing full year profit of 5 billion euros. So it maintains that full year guidance on profit of 5 billion euros. Those are the top lines coming through from this reinsurer. We're waiting for lines as well, and we have them for Rheinmetall, a company that, of course, is in focus given its central role in the defence space of Europe, and a stock that is up around 74% year to date. First half sales then coming in as a beat for Rheinmetall over in Germany. First half sales of 3.82 billion euros. The estimates had been for 3.65 billion euros. There was some scrutiny and questions as to whether or not they would raise their guidance when it comes to profits. We'll wait for any lines on that. So far, first half, the details are the operating profit for this business came in with a hefty beat, 404 million euros. The estimates have been for 315 million euros. So it's a pretty sizable beat when it comes to operating profit in the first half for Rheinmetall, 404 million euros, well above the estimates. The sales also in the period coming in higher than the estimates. The stock up more than 70% year to date. Let's check in on the broader markets then, and of course the earnings theme will thread its way through these markets, but there's a lack of certainty, it seems. We'll wait for the US jobs claim stateside to get a better understanding of the softness in the labour market stateside, and then of course we have that important inflation print out of the US next week. The comments coming through, the details on the BOJ, some voices there of course in terms of the minutes that crossed out of that central bank, and expectations from some that maybe the neutral rate is closer to 1%. That led to some adjustments as well today. Currently, European futures pointing to losses then of 0.8% after the gains of a little over 1% yesterday broadly across the European space. But it was downside for the US session. The S&P E-minis, or the S&P, ended lower by 0.8%. The Nasdaq, of course, Nasdaq 100 ended lower by a little over 1% as well, with some of the big chip names losing ground. FTSE 100 futures currently pointing to losses of 0.5%. For the S&P E-minis, you're flat. Nasdaq futures pointing to very modest gains of 0.1% after the downside of yesterday. Let's flip the board and look cross-asset. There was a 10-year Treasury sale that was not well received by the markets yesterday. That also led to some readjustments across these asset classes. That 10-year Treasury auction not being well received. The 10-year currently at 391. We have a 30-year auction later today that could be consequential as well. Just a move of 3 basis points there on the 10-year, 391. 146 on the Japanese currency. You're seeing a little bit of gain coming through, up 0.2, just shy of 0.3% for the Japanese currency versus the US dollar. Brent, $78 a barrel, up 0.1%. We continue to keep an eye on the tensions in the Middle East, and 56,000, close to 57,000 on Bitcoin, getting a bit of a lift in terms of some news lines crossing from Ripple Labs and an agreement, a payment that's come through that they've been ordered, coming in less than the SEC had requested or at least expected. So Bitcoin and crypto getting a bit of a lift in the morning session so far today. Let's switch focus right now, because thousands of anti-racism protesters rallied across the UK last night following more than a week of rioting by far-right groups. Bloomberg's EMEA News Director Ros Matheson joins me now for the details. Ros, talk us through what we saw. There were protests in London last night. I saw them next to where I live in North London, but the vast majority were protesting against these far-right racist groups who, of course, have been rioting and trashing parts of the UK. Far outnumbered, generally peaceful, at least in my neighbourhood. What transpired across the country?
Well, that's right. So they came out because, in fact, what we're expecting were these far-right groups to again come out to demonstrate in different parts of the country. We're expecting about 100 sites for them to do so. As you say, there's been riots in the UK over the past week, some of them quite violent by these groups, very destructive of property and so on. And what we saw is, in fact, the counter-movement outweighed the movement in the end. Thousands of people coming out to say this doesn't represent who we are in the UK, protecting property. You saw police out in great force as well. So, in fact, it was more police and more sort of anti-racism protesters than far-right protesters themselves. We saw only very, very small pockets of them in several places, a couple of scuffles, say, in Croydon, in the south of London, for example, a few arrests, but nothing at all. In fact, it just all sort of fizzled out. And so the question is really, where does it go from here? Is this movement now quiet? Has Keir Starmer, the Prime Minister, want a respite from it? but with his very, very tough approach. He's been fast-tracking people through the courts very quickly, making it, very clear to them they're going to potentially face jail, and that could be very, very fast indeed. He's got experience, of course, with riots before.
Yeah,
as we know.
That experience seems to be coming through, doesn't it, with a number of names being jailed just in the last day or so, maybe sending that message then to these rioters. Is it a reprieve? Do you think this is it then? Have we got through the worst of this? What's the assessment?
Well, is it reprieve for now, but is it really over? Because even if these riots end, there's the challenge more broadly for the Prime Minister, for society really, that there are these movements in the UK. There are people who've been feeling very aggrieved about migration for whatever reason for years, partly through the Brexit process, but certainly there's a strong undercurrent of this in the UK. So structurally, how do you deal with that, even if people aren't out on the street and rioting? And also this movement's quite nebulous. There's no real leadership. There's sort of gathering through, social media and very quickly. So that's not to say they're not going to pop up somewhere else, perhaps in the coming days or on the weekend again. This was something that, police knew was coming and were out in force ready to prevent. We don't know, will they come again at some point? But either way, even if we don't see big riots in the UK, the fundamental questions of what this is doing to society and what it means for the UK, those remain.
OK, Ros Madsen, thank you very much indeed on the longer-term challenges around deconstructing some of this misinformation, taking on some of the social media handles and groups, of course, that are pushing this disinformation, and, of course, some of the risks that continue around these right-wing, far-right movements, of course, here in the UK. Now to some other stories making news this Thursday. Taylor Swift's 3 scheduled concerts in Vienna this week have been cancelled over what Austrian police say is a suspected terrorist plot. 2 people have been arrested, including a 19-year-old Austrian allegedly radicalised by the so-called Islamic State group. Security officials say chemical substances were found at the teenager's home. Swift's Eras tour is due to wrap up in London later this month. The CFO of German insurance firm Munich RE speaks to us exclusively about the company's latest earnings. That conversation coming up in just the next couple of minutes. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. On the earnings front then, we've had lines crossing in the last 15 minutes or so from Munich Re, the reinsurer. It's a beat in terms of the second quarter net income for this business, coming in at 1.62 billion euros. The estimates had been for 1.56 billion euros, and reiterating its full year profit guidance of 5 billion euros. The stock is up about 20% year to date. For more details on this, very pleased to say I'm joined now by the CFO of the business, Christoph Jurecka, joining me now for a reaction. Christoph, thanks for joining me on these results then. Talk us through that reiteration of the 5 billion target around profitability for the full year. What was we know the hurricane season has been challenging. Is that what stopped you from raising the guidance on that front?
Well, first of all, good morning, and thank you for having me on the show. Indeed, we have very pleasing results again this quarter, and after 6 months, we are now already at 3.8 billion euros of a net result. By the way, the highest net result ever we had after 6 months. So very well on track to achieve our full year guidance indeed. Now, the question is, why didn't we increase it probably? Well, I would say that's the typical Munich Re conservatism. We are cautious until the very end. And the third and the fourth quarter are very cut heavy in our planning. So therefore, we thought, let's give it another quarter and see how the development goes and keep the guidance unchanged for now. But what is very clear, the likelihood of overachieving our target has significantly increased.
OK, well, that's what it sounds like. OK, so that's important. The likelihood of overachieving on that 5 billion euro profit target has increased. That's an important line, I think, for investors. Talk to us about some of these extreme weather events then. There are higher payment claims coming through for insurers and reinsurers. Are there some regions now that are becoming uninsurable?
Well, indeed, in the second quarter, again, we had a relatively high share of cut losses, slightly above our budget. Our average budget is 14% per quarter. This time, for us, it was 14.4, so slightly higher. And what actually happened was that there was not this one single headline event, affecting us to that extent, but it was a number of smaller, mid-sized events, which then added up to that overall amount. The most significant for us this quarter was a flood in southern Germany, which altogether cost us in reinsurance around 200 million euros. But then there were other events across the globe, all of them rather mid-sized, which then finally added up to the number. So in a way, a busy quarter with not a single so significant event that it would have made headlines in the news.
Is it your assessment there is sufficient capacity within the insurance sector to be able to make up for what is expected to be the increased claims around climate change?
So our clear answer is yes, there is enough capacity. So we are very happy to deploy capacity into cut risks, always under the precondition, of course, that the prices and the terms and conditions have to be reasonable also from a reinsurance perspective. But under that precondition, absolutely, there's sufficient capacity in the market, and we are very happy to deploy more capacity.
Your business, Munich RE, has been a leader in terms of cybersecurity solutions within the insurance space. How big an impact was the CrowdStrike event within the industry and for you?
That's a very good question. I would love to know myself, but it's very early days. So I cannot give you any internal insights in any internal numbers yet. We're still assessing what's going on. I think the industry estimates, as for example, just shown in the media, they have come down a bit recently. But anyway, it's early days. We have to really assess it, wait for the claims notifications from our clients, and then we'll see.
OK, Munich RE CFO Christoph Jurecka, thank you very much indeed on that earnings beat in the quarter and a record number coming through for the first half, with a hint there that maybe the profit guidance around 5 billion euros could be beaten in terms of the full year. We appreciate your time. Now, Siemens says weak demand for factory automation is hitting returns and revenue. Bloomberg's Guy Johnson spoke to the CEO of that company. Take a listen.
It was driven basically by another very strong quarter of smart infrastructure. Our electrical business grew by 21%, but we also had a very strong software business. The underlying the software business was very strong, but we also had a couple of wins, large wins. They don't repeat in that size again, but this helped quite a bit also in drive our top line and bottom line as well.
So some fairly lumpy numbers this time around, which probably aren't repeatable. You have those stuck to your guidance for the full year. Given what you've just said, given what you see in the world at the moment, how predictable is the business though right now?
Well, yes, we confirm our guidance, our full year outlook for the growth. We will end up at the lower end though. And we also confirm on our EPS guidance. The same holds true for our businesses. Regarding DI, we see their profitability for the full year on the lower end, for the SI on the upper end. So coming to predictability, it's really the biggest element which we have here is that over the last 3 years, the automation business was growing tremendously fast. And this ended up in quite a bit of stocking in our distribution channels. And this stocking effect has to go down. You have to destock on the one side and the market has to pick up on the other. This is the unpredictability. How fast does that go? When will the market pick up? We see a certain light in chemical industry, also in China, which is a leading indicator. But this is not really the momentum we need in order to really grow there. Therefore, we still have a muted market for automation. It is a temporary effect, structural. We believe this market keeps on going because there's a demand for higher automation and digitalization in the whole industry.
Right, but just trying to figure out when that happens is proving difficult. How big a factor is China in that thinking? You've talked about maybe China recovering next year. Looking at the latest numbers we see out of China, is that still your thinking as well? Do you continue to believe that we do see a recovery next year?
Yeah, that's still the assumption which we have. We will see. Our assumption is still that we still see a weak Q4 and Q1, so until the end of the calendar year, and then let's see. We do not believe that this is a kind of a fast pickup in the Chinese market. It will pick up slowly, gradually. It depends really on the one side on the domestic consumption in China, so the market itself, how it's growing. It depends also on the global markets. Remember, China is a very strong export market, so in the whole economy. And it depends also how fast will China go through their reduction of the GDP share coming from real estate. This is something that really holds them back. All in all, China is the second largest market for us, and it will remain this market, and it will come back to growth. It might take a little bit structural-wise. We don't have any doubts.
The story over the last few days has been huge debates around whether or not the US is heading for a recession. Do you see any indication that the US market is heading for a recession? What data are you getting?
Well, I mean, on the one side, Inflation Reduction Act is the right thing to do in order really to attract value added to the United States. The money is not going that fast to the market, so we see a slight pickup, but not really that impact what we would hope to see. On the one side, and the other side, I mean, ahead of the elections, obviously maybe the market is a little bit muted. But all in all, the United States was always a market which was quite resilient, was acting very fast, and we believe that this is a market which is also driving. This was now the overall perspective. If it comes to our markets, where we see the demand for digitalization, for automation, we really believe that this is a high growth market for us, exceptionally high. Why? You have labor shortage, you have high salaries in the United States compared to others. If you want to bring manufacturing back, and this holds true for the United States, maybe also for other surrounding countries, then you need a high level of automation, digitalization. Last point, AI is driving a huge demand for data centers, and electrification itself is taking a huge momentum. You see that in our smart infrastructure numbers. This goes on. This is a super cycle. It will go on. So very strong business there. Last point, we are one of the strongest players in the United States if it comes to trains and signaling, and we play that card as well. And you see our last order for high-speed trains for the United States. Yeah. That's just one element in it, and this goes on.
Okay, Bloomberg's Guy Johnson there speaking to Siemens CEO Roland Busch after they came out and adjusted in terms of their expectations. The company expecting to hit the low end of their forecasts on the back of weaker automation demand for that business. There's plenty more coming up. Stay with us. This is Bloomberg.
When market sentiment deteriorates, that can be self-reinforcing. People start to pull back on hiring, people pull back on spending. Next thing you know, the unemployment rate hasn't gone up 0.5%, it's gone up a full percentage point or two percentage point. You're in a recession.
The markets are often wrong about what's going on with the economy and what the Fed is going to be doing. There is some significant, evidence of some slowdown of the economy, but I don't think the data suggests that we're going to have a hard landing anytime soon. If anything, actually, there's some elements of strength in the economy.
Former New York Fed President Bill Dudley and economist Nouriel Roubini on the recent market volatility. Now, JP Morgan coming out with its assessment in terms of recession risks for the US and moving that estimate up from 25% to 35% by the end of this year on what they say is a weakening labour market. This is also JP Morgan, of course, who are pricing in and expecting 50 basis points in terms of the first cut in September from the Fed, and then another 50 basis point cut in November. Here's the context, though, because, of course, earlier this week we also had JP Morgan, or I should say Goldman Sachs, coming out with their estimates, moving that higher from 15% to 25% within the year. But over a 5-year period, this is the aggregate forecasts of recession risks and recession chances coming through from economists, and we're actually sitting at about 30. So we've moved lower, actually, over this period of time from about 60% chances back in 2023. On aggregate, expectations around recession risks in the US have moved less and have moved lower, down to about 30 right now, in the context of what we're hearing, of course, from JP Morgan and Goldman Sachs. Let's flip the board and look at jobless claims, because we know that's part of the story, of course, the weakening of that labour market. And last week, we saw the highest number in terms of jobless claims since about November of 2021. 240,000 is the expectation today. That number, of course, will be scrutinised given the volatility that we've seen around the softening of the labour market in the US. Bloomberg Economics, by the way, sees a jobless rate, an unemployment rate of 4.5% by the end of this year. It's currently at 4.3%, and then they see that moving higher to 5% in 2025. So we'll be scrutinising, of course, the jobless claims out of the US later today. Let's flip the board and have a look at a very different story. This comes around Bitcoin. Of course, it was hammered along with many other assets on Monday. It dropped about 10%. Still way off, of course, the record highs it hit earlier this year when it got to about 73,000. But of a bit of a respite in the session today around Bitcoin and Ether as well on a ruling and a judge court order asking and ordering Ripple Labs to pay a fine of about $125 million. Sounds big. It's nothing compared to what the Securities and Exchange Commission were looking for, which was about $2 billion. So that's seen as a vote of approval for the crypto space on some levels, paying less in terms of the fine. It's seen as a victory for some in that space versus the SEC. So you're seeing a bit of a relief for Bitcoin and Ether. This is over 5 days. You're still seeing those losses of 5.6%. And, of course, we are well down on the levels that we saw earlier this year, about 57,000 or so, well down from those 73,000 record levels earlier this year on Bitcoin. Coming up, we're going to be speaking with Zurich Insurance's CEO, Mario Greco. Another big day, of course, on earnings. We'll get his view on how that company is positioning in the quarters ahead and reaction, of course, to the earnings. That interview, 7:15 a.m. London time. The opening trade is up next. They'll be walking you through the markets and bringing you those crucial conversations on the earnings story. Stay with us. This is Bloomberg.